So you say revaluation arises whenever there is a difference, between the fair value, and the carrying amount. The carrying amount of an asset. Full stop. I hope you remember. Fair value is the market value, while carrying amount is the net book what? Net book value. Those are things you need to know. So whenever there's a difference between the market value of an asset, and the fair value of an asset and its book value, then that difference is called what? Revaluation. And I'm going to focus much on the revaluation gain. So you say down there, with revaluation surplus, debit PP account, then credit revaluation reserve account. Opposite will apply to revaluation loss, which is very rare to be examined. So that is not an issue. When there is revaluation surplus, this is what you're supposed to do. You increase the value of the assets, then you credit the revaluation what? Reserve. Where the issue comes, when assets have gained value, whenever there is an increase in value of the assets, you are supposed to depreciate even that which has increased. But in the question setup, you'll find the examiner, they put a question in a manner that revaluation has not been done what? Depreciated. So whenever there is revaluation, it is always very important to adjust the depreciation factor. So if the book value of the asset was 100, then after carrying out valuation, you realize it is now 150, then this surplus of 50 should also be subjected to what? Depreciation. So with them, you will find that they were not depreciating that 50. So that one leads to something called depreciation under what? Under charge. So right for me there, the concept of depreciation, under charge. The concept of depreciation under charge. The concept of depreciation under charge. Concept of depreciation under charge. you say this arises when the group charges depreciation, when the group charges depreciation, when the group fails to charge depreciation, sorry for that. Nelson is saying I'm breaking. Online, I hope you can hear me. So when the group fails to charge depreciation on the revaluation surplus, fails to charge depreciation on the revaluation surplus, full stop. Down there, you say depreciation under charge. How do you get the depreciation under charge? You take revaluation surplus times the depreciation rate. That is how you get the undercharge. Full stop. Another hyphen. You say the amount under charged should be subtracted from group PP and group retained earnings account. Full stop. Group retained earnings account, full stop. So that's how you adjust. You check the surplus. You know they will bring. Okay, let me read. Give me the last sittings past paper. We check so that you can understand. Get out your past paper so that you can get to understand what I'm talking about. You can get to understand what I'm talking about. Get to the last sitting, that group question 2. I've taken your paper. So like that one for last sitting, just check for me note number 1, additional information number 1. Just check the additional information number 1. They were saying, allow me to read. A fair value exercise carried out on 1st April 2017 concluded that the carrying amount of 20 limited net assets approximated their fair value So approximating fair value means the market value and book value are the same, with the exemption of an item of plant and what? Equipment, which had a carrying amount of 100 million below its fair what? Value. It means fair value was more. Sure. Was more by how much? 100. So that is revaluation. Actually, that's how they communicate revaluation. They never say direct revaluation. Whenever they tell you that the fair value and the carrying amount were different, then that variation between those two, that is revaluation. Then they continue by saying, at this, the plant and equipment are the remaining economic useful life of how many years? 10. Depreciation is charged to cost of sale. That is okay. So in that case, the 100 million is the revaluation. So first of all, you adjust for revaluation. There are two workings to be done. Number one, you adjust for revaluation of 100. When we'll be preparing the consolidated balance sheet, you increase the assets. When you are adding the assets together, you increase the PPE with the 100. Then in equity, you come up with the revaluation reserve. That is one. Two, you charge depreciation on that revalued amount. So you take the 100, you divide by the useful life, which is 10. So you get depreciation to be 10 per year. So 10 per year, that depreciation, you go and subtract it from profit. Also, you subtract it from PPE because they were not depreciating. So you have seen how they have talked about revaluation in that note. And that is what they always say, that the carrying amount was different with the fair value. That difference between fair value and carrying amount is what? Revaluation. And those two adjustments must be done. Otherwise, we shall meet in the questions. So leave it at that point. Let's go to number 4. Everyone mute yourself. Nelson, mute yourself. Number 4, dividends. What was our number 4? Huh? Number 4 was on dividends. Sure. Yes. So dividends. So I'm not going to define what is dividends. Dividends, okay, dividends is that profit, the portion of profit given to the shareholders. Just a minute. Yeah. And you feel just because having some engagements out of Sorry for that. So I said we are not going to define what are dividends. Dividends is that portion of profit distributed to the shareholders. Our main concern comes here, which you need to understand properly. A company was intending to pay dividends at the end of the year. And let's assume that the financial year starts in January, which goes all the way to December. That is example. Then this company was intending maybe to declare dividends of 100 million at the end of the year. Then along the way, let's say on 1st April, they got acquired by another company. You know, once you've been acquired, like the day we saw here, cooperative acquiring 90%. You know, once you've been acquired, you don't have say. Those people will be controlling. So it means those shareholders who were there before might end up losing their what? Dividends. So how do we go about the dividends, the proportionate value of dividends before acquisition? Before acquisition is called pre what? Pre-acquisition period. After acquisition, we call what? Post-acquisition. So how do we treat the dividends in the pre-acquisition period, and how do we treat dividends after acquisition? That company was intending to declare dividends, but before they declared, they got acquired. So it means if you don't talk about these dividends, they will just get lost like that. Those people will dominate you. So the accounting treatment is simple. The proportionate value of dividends for the pre-acquisition period should be treated as part of net what? Part of net assets. They should be compensated. They should be compensated. While in the post-acquisition period should be credited to profit and what? Loss account as income. After acquisition, now the parent treats everything which is coming from subsidiary as income. But this one they need to compensate as net assets when they are determining the purchase consideration. So right there and say, the main concern is on how to account for dividends that had been acquired. How to account for dividends that had been paid, not acquired, that had been paid by a subsidiary company, that had been acquired during a financial period. During a financial period. Full stop. Full stop. Correct. So another effect, you say the proportionate value of dividends, before acquisition, the proportionate value of dividends before acquisition, in brackets, pre-acquisition dividends. Pre-acquisition dividends should be credited and recognized as part of net assets. When determining goodwill. Credited and recognized as part of net assets when determining goodwill. when determining goodwill. While the post-acquisition dividends, should be credited. The post-acquisition dividends, post-acquisition dividends should be credited to profit/loss. Should be credited to profit/loss as part of income. As part of income. Full stop. Full stop. Full stop. Full stop. Can someone take a photo, send in the group? There's some people crying on network. Hey, ladies are good. Just take a picture to send in the group. What you have written on dividends. So I want us to check an illustration. Someone is sending you on dividends, just in case you have an issue. So I want us to write this illustration, right, and say H Limited acquired 80% of S Limited on 1st October 2021. S Limited declared a first and final dividends of shillings 320 million on 31st December 2021. Both H Limited and S Limited prepares their books on 31st December each year. 31st December each year. Required show how the above should be accounted for by the group. I write that one. Write that illustration. Good one. Yes, one.
Ya buku. Mwana tokwa guthia umire handu we ndiotana gwetagirira mie na my answer was already na already nyuma na answer ĩrĩa ndĩmuonire Hi. To a class in the morning. Yeah, first and then I come.
So have you even done that illustration? We are waiting for me. We can do it together. So it goes this way. The financial year is ending when? 31st December 2021. So this one must start when? 1st January 2021. When did they acquire the subsidiary? 1st October should be somewhere here. 1st October 2021. So this period, how many months before acquisition? From here to here, how many months? 9 months. So we have 9 months. 9 months pre the acquisition. Then we have how many months post acquisition? 3 months post acquisition. Very good. Very good. So now, number one, what you need to know, the parent will acquire, even those dividends, they will compensate them when they are paid. Now it will go to them. So you will come and debit. So say here, debit, dividends receivable, account with 80% of the whole amount of 320 million. What is 80% of 320 million? to 256. Thank you. Then you credit the net assets when determining goodwill. 80% of 320 times 9 months. So this is for goodwill determination. Now this is the this is pre-acquisition. Pre-acquisition. How much? 192. Then you credit P&L, profit and loss. That is after acquisition. That one goes to income statement as income of 320 for how many months? 3. That is post. Post acquisition goes to the profit account. So how much? 60 something. 64 million. Full stop. As simple as that. So we'll meet them in the question. If they pay dividends at the end and it was acquired during the year, this is what happened. You create something called dividends receivable, the whole amount, then you credit net assets. So in determining goodwill, we're taking purchase consideration minus the net assets. So this one forms, the 192 will form part of the net assets. You add it there. Then this one you credit as income later. So let that one rest at that stage. We go to the last adjustment. What was our last adjustment? Intergroup transactions and balances. Right that way, intergroup transactions and balances. Intergroup transactions and balances. So write and say intergroup transactions arises. Intergroup transactions arises. Intergroup transactions arises. When group members transact with each other. Group members transact with each other. Hey, look, man. Hello. Hey, I was saying, as we try to follow the chart, because I thought about it like what we talk about. Then they start seeing this. So we are saying it arises when group members transact with each other during the financial period. Transacts with each other during a financial period. During a financial period. Full stop. Full stop. Full stop. Another item. Such intergroup transactions should be eliminated in full during consolidation. Should be eliminated in full during consolidation. Full stop. E.g. intergroup sales. E.g. intergroup sales. So what that means, intergroup transactions, you find that parent sold goods to the subsidiary sold goods to the parent. When you are conducting consolidation, whatever they sold amongst themselves, you do what? You subtract. It is not supposed to go to the consolidated books. Are you together? Down there, you say intergroup balances and debts. Intergroup balances and debts should also be eliminated. Should also be eliminated. Should also be eliminated. Should also be eliminated against. Should also be eliminated against trade receivables and trade payables. Trade receivables and trade payables. Trade receivables and trade payables. So if they owe each other, subtract from receivable, subtract from payables at the same time. Another item, any difference in intergroup balances, any difference in the intergroup balances may be due to any, what have I said? Any? Yes, any differences in intergroup balances may be due to one, cash in transit, goods in transit, or errors in the accounts. Or errors in the books. So what we are saying, you know, these people are transacting with each other. Then at the end of the year, you are told that in the books of the parent, the amount due from the subsidiary is 80. But in the books of the subsidiary, amount due to parent maybe is how much? 60. So what the parent is requesting subsidiary to pay is different with what subsidiary is saying they are supposed to do what? To pay. So should there be these differences, then these differences can be caused by either of these three. But the one which is common, if they are silent, in most questions they're going to be silent. That parent is asking 80, this one is saying 60. Should they be silent, then that difference we normally consider to be cash in what? Transit. Meaning, these people have paid 20, but these ones have not done what? Received. That is why they are still talking of a high amount. So if the examiner is silent, which I know in most questions they will be silent, there is intergroup debt, but they are not telling you why there is that variation. Then that variation we assume it is cash in what? Transit. And to be specific, if it is goods in transit, they will say errors in the books, they will say. But if they are silent on why they differ on the balances, then that balance is cash in transit. So the question is, how will you adjust for the cash in what? Transit. So I don't want to do many write-ups. If I do this, you'll understand. Just put in brackets. So if it is cash in transit, you add to cash book, comma, you less from receivables. Like that. Because this person was expected to pay, this one was expected to receive. So reduce payables, then add it to the cash book. This one, just in case, you add to inventory, a plus to inventory, a minus to receivables. Errors, we deal with them as they come. So, yes, correct. So those ones will meet in the questions. Subtopic, before I give you a small break, subtopic, consolidated, subtopic, consolidated statement, consolidated statement of profits or loss. Consolidated statement of profits or loss. Hyphen, have an hyphen, format. So take a small break and we come back to that format. First, let's give the format. Let's give the format of consolidated profit loss account. So right there, H group, consolidated statement of profit stroke loss. For the year ended that. So revenue excluding intergroup sales. Excluding intergroup sales. Cost of sales excluding intergroup cost of sales so that we'll be able to get the gross profit. Gross profits. So then after that, we bring investment income. Investment income excluding intergroup interest and dividends. Intergroup interest and dividends. Then share of profit after tax. PAT is profit after tax in associates. I'm introducing associates and joint ventures shortly. So there are mostly those ones. Then distribution cost. Distribution cost. Administrative including impairment loss, finance cost, then we get profit before tax. Profit before tax. Then income tax. Income tax. You get PAT. Then you say profit after tax, attributable to NCI and holding company. So there, then total there. So call this one A, call this one B, then this one will take A minus B, then this one is A. So have that the way it is. Yes. Yes, for you. Good afternoon, for you. Yes. So that is it. That is how you prepare consolidated statement of profit or loss. We'll meet them during presentation. Now, the issue is on this B, this one. B is the profit attributable to NCI. You know, once you get the total A, then you distribute A to these two, minority and the parent. So minority, the one we are calling B. So what remains after minority has taken theirs, you give to the parent, which is A minus B, this one. So you have this and this, it will take you back to A. Sure. Yes. But now, how do we get the profit for the minority? Remember, minority, they are only the subsidiary. So down there, you show me this. PAT to NCI. So profit to the NCI is calculated as follows. You take PAT of the subsidiary, you add, not you add, you less UPI if it was upstream. You remember the upstream? Upstream means the subsidiary is sold. So that is when you subtract, that is when NCI is affected. You less impairment if it is which method? Full. Full method means NCI also participated in goodwill. If it's full method, you less. Then you add back, add excess depreciation. Excess depreciation, you add. Then you less depreciation undercharge. Not even all of them will be there. You will even find one or even none. You just make it to profit and you share. So what you get here is the adjusted PAT. So the adjusted PAT, call it Q. Therefore, NCI will take the percentage of NCI times Q, which is equals to B. So this B which we got here, this B is as a result of this one. So once you adjust the profit of the subsidiary, you give minority their percentage. If they were controlling 20, you give them 20% of that profit. Then that is what you take here. Okay, so that is it. So I want to introduce two elements known as associates and joint arrangements. Then from there we are due for a question. And because there are some write-ups we need to do, and if we write them now, we won't manage. I've shared with you the notes on associates and joint arrangement, the group. So I want us to discuss them without you writing. We discuss, then over the weekend, you go and write them down. When we meet in our next class, we start computations. I think that's okay. Yes, so go to the group. I've shared some notes there. Though the handwriting, I don't know whether it will be compatible. but it will just have to be compatible because it must be. So open. That's all. Sawa. Alright. So now there is something called, you have started writing. Good spirit, eh? Continue with the same. There's something called associates. I want us to read, thanks to those people who started writing, is an entity over which the investor, who's the investor? Parent, correct. In which the investor has significant influence. What is significant influence? It is the power to participate in the financial and operating policy decisions of the investee, but without control or joint control over such policies. You just attend meetings, then you raise up your hand. How many people are happy? We are happy. Let's proceed. But you don't have control. Like right now, if you have shares in Safaricom, if people are just being asked in AGM where people are many. Mr. So-and-so is going to be the CEO. How many people are supporting you? Carry up your hands. But tomorrow after that meeting, can you go and say, I'm a shareholder here, I want him out? You don't have control. You just have significant what? Influence. So the parent has no control. What are some of the indicators of significant influence? Representation in the board of directors or equivalent governing bodies of an investee, participating in policy decision process, material transactions between the entities and the investee, interchange of managerial personnel, and the provision of essential technical information. Those ones just read, they are frequently asked. Then there is IFRS number 11, joint arrangement. This is an arrangement in which two or more parties have joint control. Joint control exists when you're controlling what percentage? 50-50. Types of joint arrangements. Ignore that setting of November 2020. Just ignore it. Don't write it. Ignore. I checked, that person was not keen. So joint operations, there's an joint operation. It's an joint arrangement where the parties that have joint control of arrangement have rights to the assets and obligation for the liabilities relating to the arrangement. Then the other one is joint ventures. It's a joint arrangement where the parties that have joint control over the arrangement have rights to the net assets. So what separates the two, the joint operation and joint ventures, is that in a joint operation, they have right to the assets and obligations. But this other one, they have right to the net asset. You know, net asset is equity, capital. So they have equal rights to the capital, but in a joint operation, they have right to all the assets. Everyone has a right to 50% assets, 50% obligation. But in a joint venture, they only have rights to the capital, which is very true, even when people stay as bachelors. So you can stay as two bachelors in one house. Someone has bought everything, TV, chairs, and everything. So that other person, what they need to claim is the rent which they contributed when you are coming in, but they don't control the assets. So in that case, they have equal rights to the capital, but not assets. But if you have equal rights to the assets and even obligations, then now that is a joint operation. Accounting treatment for associates and joint arrangements. You know, two of them are accounted for the same way. So they are accounted for using equity method of consolidation. So what is equity method? Is a method of consolidation whereby the investment is initially recognized at cost and adjusted thereafter for post-acquisition changes in the investor's share of the investee's net assets. So what they are saying, in equity, you recognize your investment, how you invested it, then as time goes by, any post-acquisition profit which comes, revaluation, those equity, you keep on topping up. This method disregards, and that is what I want, this method disregards associates and joint arrangements as part of the group members. And therefore, any intergroup transaction between them and any group member should not be eliminated during consolidation. Very important, very important. Listen and listen carefully. Associate starts from what percentage? From 20 to 49. While joint arrangement is at what percentage? 50. So any company from 20 to 50%, we don't consolidate for them. We don't. You only consolidate, you know, like now, if you have shares in Safaricom and you want to prepare your financial statements, do you call Safaricom that I want to prepare my books? So I'm combining my vehicles. Can you tell me how much vehicles do you have there? I want to combine with mine. You can't. Why? You don't have control. But if you have control exists at 51 and above. If you have control, then you take all their assets and all their liabilities in your books. But where you don't have control, that is 50% and below, then you are not supposed to consolidate for them. So in the question, the examiner will give us parent, subsidiary, and maybe associate. This one you are not supposed to do what? Consolidate for them. However, go down there. However, the parent will be entitled to its share of dividends and also profit after what? Tax. No matter what percentage we have, we are entitled to dividends. Sure. Yes, we are entitled to dividends, no matter what percentage we have. So please, that is not what makes different between you and others. Where the parent is controlling, not even controlling, owning between 20 to 50, ignore during consolidation. Just tell us how much you invested, how much dividends are you interested in, and what is now currently, what is their profit, then you take your percentage. All other things, examiner will give you everything, just ignore. You don't consolidate for them. And if there is any transaction, like they sold with the parent, you don't eliminate because they are viewed as third parties. You know what you said to third parties, you don't subtract as intergroup. Even if you check my definition of group, we said group consists of parent and subsidiaries, not associates, not joint arrangement. They are not considered as part of group. And that one you will even do in company law, that associates and joint arrangements are investments. They are not part of the group. So you find their transactions, assets, liabilities, income, expenses, don't consolidate them. When bringing for the parent and subsidiary, don't bring for these others. You are only allowed to bring for the parent and subsidiary. Are we together? Yes. Exemptions to the application of equity method. So when are you restricted from applying equity? When the entity has ceased to be associate or joint arrangement. Maybe we were having 50, then we topped up 5%. Now it's at 55. You see now that it has become a subsidiary. So you don't disregard them. When the parent itself is fully or partly owned by another entity, if your parent is acquired by another company, you will not even consolidate. Where the parent debt instruments are not traded in any public market. So you cannot own those if you are not, you must be in the stock market, and where the parent does not file its annual returns with relevant authorities. Those are criminals. So if you don't file returns, what do you want to consolidate for our books? So I want you to, once again, as you write them, you read again the way we have explained. Then now when we come straight, I will take you to illustration. And I will start most so with the last setting as we go backwards. My intention for group is to do 5 questions. Is that okay? Yes. So on Thursday, we do 1. On Friday, we can do 2 because learning curve will have increased. Thursday is holiday. God has done it again. Eh? God has brought another one. Thursday is holiday. Yes. So, will we afford to miss class? Yes. Me, I don't want to teach on holidays. We will not come. So what God has brought to us, we have to appreciate. So we'll meet when it is there. So thank you so much. Do have a nice weekend until we meet again. But make sure you finish and you read those theories, because hey, before we stop, when we come next time now with questions, it will depend whether you understood these things. The UPI, excess depreciation, impairment, you saw them in the additional information. So it will purely depend whether you have understood. So make sure you read them. When you are reading, you will not know that you have understood them until the question comes. So be careful. Thank you. No, simple treatment, simple investment has the same treatment as associates and joint arrangement. You don't have control. So just the same. The only issue is that rarely do they examine simple investment, but treatment is the same. We ignore them. God has brought another holiday.